Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you on Wednesday, August the 7th. The year's 2024. Let's talk trading. Trading with Walmal. These videos are for educational purposes only. Your results may differ from mine and different from Walmal's. And as always, risk management. Never lose more than you're willing to lose on any one single trade. So, Walmal, you've pretty much done for the day, right?
I am done for the day. Was a relatively easy day. I haven't taken any losses today, so that's always a good sign, right?
Right. Well, a trader had written to me and was asking something about moving averages. Squiggly lines is I like to tease about. So, what happened was one of these trading emails that I get either on a daily or weekly basis, they talked about one of their setups, and this is something, I guess they're more of a stock trader, but I think it would still be applicable to the foreign exchange. So they were saying that if the EMA 10 line is above the is below the EMA 20, which is below the EMA 50, that this would indicate you should only be looking for shorts, and then vice versa. If the EMA 10 is above the EMA 20 and the 20 is above the 50, you should only be looking for longs. And one of the things that I like to tease about squiggly lines is because if you look on one time frame, you'll get one signal. But if you look on another, you can get the complete opposite signal. So, I mean, way back when, I don't know, 20 years ago, maybe, or no, I guess it's more like maybe a dozen or more years ago. I used to use squiggly lines on multiple time frames, and then I just moved away from it to horizontal lines because it just seemed to make more sense to me. Because you can see here, it's saying let's go short on M1. I just noticed something. I must have used some old code because this isn't highlighting. Then on M5, you have cross signals because you've got looks like you've got the 10 below the 20, but both of those are above the 50, so that's a no signal. And then here on M15, you've got M50 on the bottom, or EMA 50 on the bottom, the 20 in the middle, and the 10 sitting right here above them both. And it's telling you should go long, but you can see here what happened or what's happening. You wouldn't want to look for longs. Now, they would call this a pullback. And so I guess you would wait so long as it stays, that these stay in this configuration. You would then go long, and then right here you can see some crossovers where it went from one signal to the other. I guess maybe a history indicator along the bottom might work for this particular indicator too. I might have to do that. Walmal, did you ever play with squigglies?
Yeah, I think everybody does at some point in time in their trading career. It's just a natural part of it. I didn't go as crazy as like playing with, RSIs and MACDs and all that type of stuff. Didn't really play with that. But sure, moving averages, I think moving averages are, something that, it gives you a good indication of what's going on in the market because it's telling you what has happened in the past, sure, but it also is, when you look at things statistically, one of the things that you learn if you take any, any statistic classes, your math professors are going to tell you one thing. The thing that matters most is not where you are on the chart right this second, but what is the direction that you're going in. And so that's what's really good about, like, let's say, moving averages, because it's telling you, hey, you're above, let's say, EMA 5, which is cost indicator 2, and you're staying above indicator 2. What does that mean? That means the market is more than likely moving up. And sure, you should be able to look at the candles and see that, but something about having that line on the screen helps you out a little bit. And then I think what can really, you said something that was, it's absolutely true. The scary part about squiggly lines is that no matter what time frame you look at, you may go and start seeing, cross signals. In other words, you may see, hey, I should be going long on the 1 minute and short on the 5 minute, or whatever it may be, and you can wind up in a situation where, I don't know what to do here. I got paralysis because of analysis, because everybody's telling me to do something different. So then you start making rules up for yourself. One of the rules you start making up, and I'm talking about myself, I did this. You wind up saying, I'm not going to go long unless I'm above indicator 2 on every single time frame. Okay, well, that's going to take you out of a lot of trades, because how often do they all line up? And, it just doesn't happen very often. And you'd say, well, at least when it does happen, you have this strong indication. Well, here's my take on that. There's a good possibility if you get all of your indicators all lining up in one direction, that move in that potential direction, is probably nearing its end. It's probably getting to the point of what we call exhaustion, and now there's no movement left.
Right.
And so you got to be very careful. So what do? I look at a basket of them. So in other words, I'll look at the 1 minute, I'll look at the 5 minute, I look at the M30, and I look at the three of them together. Or if I don't look at the M30, I'll look at the H1. And if I'm in good company with those three, I'll go and say, okay, that's a good. I like being here. And I don't usually, in fact, not that I don't usually, I never use it as an indicator to get into a trade. I use it more as an indicator to go and stay in the trade and let it run, or to get out.
Yeah, because what I did was I made an observation, ever since you started talking about edge trading because of the way things were moving. So I got in indicator writing again this week. I hadn't made anything new since April, full disclosure, but I whipped out a few. And so right here, you can see I've got the upper wick zone, or the high, what I call the high wick zone, and the low wick zone. And the way this indicator works is you tell it how far back you want it to look to. And where is it? Right here. I call it the highest high, lowest low wick zone indicator. So you say where you want the start period, and then there's a threshold period. So I want to look at the last 60 bars, basically, on the current period. So right now we're on M1. So just look at the last 60 bars, or last hour's worth. And you can see right here what it did was it put in a lower wick zone, but not much of one. And then it shot right up. Well, before these past 2 minutes, it had put in a lower wick zone, and then it kept doing this. Now, as you can see, when will you make a trade? Well, if it's leaving the wick zone, that's one way of doing it. Now, what I was using that indicator I just talked about, or the little method, the 3 EMAs, and which that's not the complete method because they also use some stochastics and all that, but I didn't want to do it. I just like this. This is basically saying a bias. So you should be looking for shorts. So back here, even though it put in a lower, it said, hey, look for shorts. So if this indicator is red on M1 and I'm trading using an M1 chart, this tells me if I go long, I'll take 2 pips, 1 pip if it stalls, or maybe at the most 5 pips. Because if you look from here, let's what do we actually know? If you look from here, this was before it broke that level, 16 to 18. So until it hits it a second time, I'm not going to look for more than just a couple of pips. And then you see here, it went up a couple of pips, came back down, touched, got into that. Actually, it made a newer zone, right? A lower wick zone right here. You can see this low of this white candle's lower. So now that it made a new one, I'm still only going to look for 2 pips. It came back down into that area. Now, I might look for more, but because this was red, I'm still only going to look for 2 pips. And so you can see here, it's hitting at a local, what I would call a local high, because if you put there, you see 1, 2, on the third one it broke it. Since the indicator's still red on this time frame, I'm still not looking for more. And it would have been a good thing because then here on this, after the second one, it came all the way back down. Then it shot up. And so this was a turn trade. If any of you guys remember that, we have a black followed by a white, so price turned. You just, if you believe it's time to go, you can just jump in that trade right there on the open, and you could have picked up, oh, maybe 2 or 4 pips. But once again, because of this, you can see it moved up nicely, started to pull back. It right here at this point would have been a great place to exit the trade. And then you can see here 1, 2, and then 3, and then 4. It's starting to push up. You can see you've got your candles here, M1, M5, M15 are all green. And you can see here on M15 that's green. So if you were trading off of an M15 or 15-minute chart, you would see this is what you'd be looking at. So, and then I have this DOL indicator, which also is a bias. And unfortunately, I had was reading something, and I just coded the indicator, and for some reason I didn't put where I got the idea from. So I don't know, but it was there's 4 charts. Maybe it's one of those trading PDFs some traders like to send out, because I like to code these things. It helps me understand it, and sometimes I learn something new, and sometimes it's actually something that I can use. And all these indicators here just tell me either stay in the trade if you're going in a direction, be careful if you don't even have a signal, and then if it's going in your direction, you might be able to ride it for nice rides. And you can see here on M15, it put in that higher wick zone there, trying to see if there's a, then you can see here sometimes it doesn't quite hit that lower area before it turns. And because I'm using 60, we're even going back to the previous day. So, fellow traders, as usual, the fastest 15 minutes in trading goes by really quick. So, probably talk more about those indicators later and other ideas, and then we'll probably start to get back into some trading psychology. Because remember, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.